Ladies and gentlemen, good day and welcome to Tech Mahindra's earning conference call for the quarter ended March 31st, 2024. Please note all participants' line will be in listen-only mode and there will be an opportunity for you to ask questions after the management opening presentation. Should you need any assistance during the conference call, please raise your hand from the participant tab on the screen. While asking questions, request you to please identify yourself and your company. Please note this conference is being recorded. I now hand the conference over to Tech M Management. Thank you, and over to you, sir.
Thank you, Vandit, and good evening, everyone. It's a pleasure connecting with you again. In addition to the updates from the recent quarter and the financial year, Rohit and I will share our 3-year strategy with you today. We will also touch upon the actions that we have already taken to achieve our goals. But before we deep dive into our roadmap to FY27, let me brief you on Q4 and our FY24 performance. We report a revenue of $1,548 million in the recent quarter, which is mostly in line with our expectations, as the one-off revenue in Q3 was not expected to recur. This is a decline of 6.4% YOY on a constant currency basis. We closed the year with a revenue of $6,277 million, which is a decline of 4.7% on a constant currency basis as compared to revenue in FY23. This decline is mainly driven by the headwinds in the communications vertical, while the non-communications vertical remains stable year over year. We report an operating margin of 7.4% and free cash generation of $129 million in Q4 FY24. For the full year FY24, we have generated a free cash of $676 million. In terms of deal wins, we signed large deals with TCV of $500 million in Q4, taking the total deal win TCV in FY24 to around $1.9 billion. This also includes the 2 large deals that we signed in Q4, each over $100 million in TCV. A couple of notable deals include our deal with a large telco and our long-term partner to transform their business processes across multiple service lines that include customer operations and experience, complex enterprise operations, back office and support operations through deployment of intelligent automation and new age customer experience technologies. Another deal is with a European fintech major, which selected TechM to enhance their customer experience and provide global support from multilingual hubs while ensuring compliance with local regulations in each of its customer markets across Europe, America, and Australia and New Zealand. In terms of awards, our strength lies in the 145,000 plus strong workforce, and a testimony to that is the fact that we have once again been recognized as the best organization for women by ET Now. We have also been recognized as the ESG Champion of India 2024 Software and IT Services by Dun & Bradstreet. We are the only Indian IT company in the top 5% of the global sustainable companies and a member of the S&P Global Yearbook 2024 for the 9th consecutive year. In terms of dividends, on a full year basis in FY24 and in line with our capital allocation policy, the board has recommended a final dividend of rupees 28 per share. This will bring the total dividend for FY24 to rupees 40 per share. In terms of FY25 outlook, as we step into the year, we believe that it will be better than the previous one. In a world of heightened geopolitical turmoil coupled with fast evolving AI capabilities, organizations will have to address and adapt their businesses like never before. They are then turning to technology partners like TechM, who can help them transform at speed and bring agility, resilience, and efficiency to their businesses. I will now hand it over to Rohit to take you through the financial performance in more detail.
Thank you, Mohit. Good evening, everyone. Let me now cover the company financials in a little bit more detail for the quarter and the year ended March 2024. As Mohit mentioned, we ended the fourth quarter with a revenue of 1,548 million versus 1,573 the last quarter. On a reported basis, this is down 1.6% QOQ, which we had mentioned based on one-time revenue the last quarter. But when we adjust for currency, the decline is actually only 0.8% sequentially, which is better than our expectation earlier shared. Revenue in terms of INR terms is 12,871 crore versus 13,101 crore in Q3. The decline is revenues mainly attributable, as I mentioned, to the non-recurring revenue from the previous quarter. In Q4, communication vertical declined by 2.8%, adjusted for FX by 1.7%, manufacturing by 0.9% decline, and BFSI grew by 3.5% QOQ. The large deal TCV, as Mohit mentions, 500 million up from 381 million last quarter, and the deal wins has been quite broad-based across different verticals. From an EBIT perspective, we report an EBIT of 114 million for the quarter, which was up from 84 million last time. In rupee terms, 946 crores, up from 703 crore in Q3. The resultant margin for the quarter is 7.4%, which is an expansion of 200 basis point QOQ. And we had mentioned that we had some one-off items last time, and hence our normalized EBIT was 7. This is ahead of that, and basis the normalization rate of 7% we'd shared. Following the periodic portfolio valuation exercise that I'd shared last time, we'll go through the impairment assessment for all our portfolio companies. We'd had a charge of 37 million in Q4, which was offset by a corresponding reversal of deferred payout provisions, reflecting a higher miscellaneous income that you see. So the net impact impairment and this reversal is negligible on the P&L. The effective tax rate for the quarter is 30.7%, which had some one-off items as one of our subsidiary companies, which resulted in the PAT number of 79,661 crores in rupee terms, and a PAT margin of 5.1%, and expansion of 120 basis point versus Q3. Free cash flow was 129 million for the quarter, and DSO days came down to 92 days. Total hedge book as of March 31st stood at 2.4 billion versus 2.3 billion last quarter. And based on our hedge accounting, net mark-to-market gain for the quarter was 23 million, out of which 7 million was taken to the P&L and 16 million was taken to the reserves. From a cash perspective, we ended the year with a healthy cash balance of 949 million, in rupee terms, 7,912 crores. Moving to the full year performance, revenue stood at 6.277 million at a constant currency decline of 4.7%. In rupee terms, revenue was 520 billion, a decline of 2.4%. When you look at the overall yearly performance, the decline, as Mohit mentioned, mainly came from the communication business, driven by the volatility in that segment, and other verticals remain flat. Manufacturing and technology were the two verticals we grew for us, manufacturing by 7.3% and high tech by 1%. In terms of full year cash flow, our cash flow for the full year came in at 676 million. And as Mohit mentioned, basis that cash, the board has approved a dividend of 28 rupees per share, taking the total dividend for the year at 40. The TCV wins for the year stood at 1.9 billion. And some of this was also as a result of our selective deal participation, which we mentioned earlier. In terms of year-ending EBITDA, we ended up at 599 million with a margin of 9.6%. And the EBIT for the year was 380 million at a EBIT rate of 6.1. The decline year on year, as I mentioned before, is broadly driven by a reduction in revenues, one-time client actions, and some of the actions of de-risking the portfolio for long term. I now hand it back to Mohit to take you through the strategy.
Thank you, Rohit. So friends, we've just entered the new financial year, and just over the past couple of days, our entire global leadership team met here in Bangalore, and we've been talking about our vision for FY27 and our strategy to get there. We wanted to share our path forward with you. From my perspective, I've been associated with the industry now for over 2 decades. But over the past year or so, as we speak to our clients, as we speak to investors, as we speak to analysts, it is very clear that we are now living in a new era of scale at speed. And this is the vision that we wanted to share with you. So what does scale at speed really mean? I think what it very clearly means is that the way large enterprises look at their technology estate, the way that they look at their operations, this has fundamentally changed. And this change really is historically, you were given a choice of scale or speed. So if you think about it, as a large organization, you were either thinking of scale, which is really like assembling a large land army, or you were thinking in terms of speed, right? Which is, how do I get a ninja team? How do I get a small special forces type operation? And really, that duality of scale or speed has now morphed into the need for scale at speed. And this is something that we're really seeing across industries, right? It's been driven by AI, but before AI, it was driven by the consumerization of technology. It's been driven by demographics. It's been driven by geopolitics. And we are seeing this scale at speed imperative really across industries. Telecom historically has been the industry that's been at the heart of tech. And as I look at the telecom business, it's a large and complex global business. So the need for scale is really quite self-evident. You've got complex global networks. You've got complex client segments, right? So for instance, in the B2B business, you've got everything from large global multinationals to national players, to small enterprises, to very small enterprises. You've got the complexity that comes from multiple channels and the legislative complexity that comes from jurisdictions like the EU, or the rules of specific markets like Canada or the US. At the same time, in the telecom business, you've also got a need for speed. You've got margin compression, you've got a change in technologies, and you've got a change in consumer behavior. For instance, the move towards prepaid. So you are seeing the twin imperatives of scale at speed. In manufacturing, again, a business that is at the heart of the entire group and at the heart of TechM as well. The need for scale in the auto business, for instance, is very evident, right? You cannot be a scale player unless you've got, you're churning out hundreds of thousands of cars. You've got the complexities of not just in time, but also a just in case supply chain. But at the same time, you also need speed. When customers buy a car or when they buy a consumer durable, they almost expect it to transform on a daily basis, right? They're looking to consume it as a service, and they're looking for improvements every single day. And so the scale and speed imperatives are equally true for the manufacturing business. If you look at banking, banks are large and complex global beasts. Historically, we've had financial supermarkets because consumers, whether they're corporates or individuals, do expect multiple services from the same organization. And all of these separate and complex products need to come together for a single consumer. At the same time, you've got a need for speed. Regulators are completely unforgiving of tardy actions by banks or insurers. We are seeing fintechs enter into the most profitable niches. And so therefore, large banks have been extremely nimble in the way they respond. And so again, the scale at speed imperative within the financial services business. I could keep going on, but we're seeing the same imperatives in high tech, in healthcare, and in life sciences. And so again, you see this imperative across the board. But here's the really interesting piece, right? That the imperative is true for our clients, but it really hasn't come through when you look at the provision of technology services and of the provision of digital services. The largest players, right? You got players with 800,000 to a million employees. These are large and complex bureaucracies, large and complex organizations with complex processes and sort of a complex hierarchy. On the other hand, you've got boutiques, which are nimble, but beyond a thin veneer of talent at the top, there isn't really a depth to the organization. There is the inability to provide services globally. And there is the risk. There is the risk that comes from not being able to scale up for large programs. If you look at AI, for instance, right, a lot of our customers, all of our customers are looking for AI to make a difference to their business at scale. They're not looking for pilot programs. They're not looking for individual initiatives. And so while the end user industry has changed, while banking has changed, while telecom has changed, in terms of the tech partners, you either have scale or you have speed. And this essentially is the tech and promise, scale at speed. From a scale perspective, at $6 billion plus in revenue with 145,000 employees, and more importantly, with a full stack of services. We have the scale to work with the largest global corporations. With the rich heritage of the Mahindra Group, we have an understanding across multiple industries, right? We have telecom, but we also have auto and financial services, and real estate and hospitality. So a deep understanding because of the group and because of our client base across multiple industries, a full set of partnerships, which gives us scale. And the promise of speed, that really comes from three essential elements of our DNA. It comes from the history of the company and the traditionally entrepreneurial approach the company's had, the very entrepreneurial spirit that TechM has always had. The second element of our DNA has been the structure that we have created, an SB1, a service line structure that gives us immense flexibility and speed. And finally, the third element that promises speed is our huge focus on learning. We have a large global university in Mahindra University. In addition to that, we are investing heavily in training. We've just appointed a new chief learning officer under our chief operating officer to build out a large learning program in addition to what we already have. So speed comes from the heritage of the company, comes from our structure, and comes from our deep focus on learning. Client feedback and investor feedback has really validated that this unique strength is held to be true on the ground. We have dozens of examples where we can share with you where the benefits of scale at speed are clearly evident. But obviously, in the interest of time, I'm going to talk about two really interesting examples. And the first is from this really iconic brand of Cartier. And for hundreds of years, the way engagement rings are bought really hasn't changed. You go to the store, you pick out a ring. Until recently, Cartier wanted to take this process online and allow deep personalization through a website and an app. They partnered with us first in Japan, and we made it happen in 3 months. So that's speed for you. Then over the next 12 months, we scale it up globally in 12 languages, and that's scale for you. That's scale at speed. TechM, born, tied with Apple Vision Pro for the Webby Award this year in the category of Best Design for Web and Mobile. And that is a brilliant example, from us of scale at speed. The second example that we have is from a North America Tier 1 telco leader. We worked very closely with them to complete their pivot to the public cloud in 2 years with TechM. Before TechM, the client needed to increase cloud migration velocity to meet their data center exit timelines, but it was moving incredibly slowly. They could only migrate 6 workloads over 8 months. With TechM, again, a sea change in the way the program moved ahead. With a cloud migration factory program, over $100 million program, 400 plus IT workloads migrated to Azure. 200 plus apps were retired in a span of 18 months. And this enabled them to, lower the number of data centers from over 2 dozen to 6 within a 3-year period. From 6 workloads in 8 months to, over 1.2 workloads per day. Again, a terrific example, from our perspective of scale at speed. So scale at speed is what enterprises need today. And with our experience, with our expertise, with our entrepreneurial DNA, with the focus on learning, we are ideally suited to fill this requirement. So now I wanted to share with you our vision of how this promise of scale at speed is becoming a deep rallying cry within TechM. Wanted to share our bold vision for what we hope to accomplish in the next 3 years. And really, the right place to start is to look back at the last 9 months that I've been in TechM and the last 4 months that I've been the CEO, about my understanding of the organization and its unique strengths and opportunity areas. So what I've learned about TechM is really the most important thing is the deep engineering roots of the organization, the immense talent base among the 145,000 strong people that we have within the company, being part of a large group with experience across industries, a marquee set of clients with deep relationships, a comprehensive full set of offerings for global 2000 companies, and a deep entrepreneurial energy which goes to each and every one individual in the company. We have historically been a leader from an ESG perspective. So these are the deep strengths that TechM brings to the table. However, There are obviously areas where I think we can and we will do better. The first is in terms of scaling large accounts. We have an incredibly rich marquee list of accounts that come from, from our 2 decades of history. We need to be able to scale these. As we move to a service line model, I feel that we have the opportunity to win multi-tower large deals by really integrating our capabilities more effectively. We've historically done a number of acquisitions, and now is the time to drive synergies, for ourselves and for our customers from these acquisitions. We have the opportunity to drive significant improvements to our cost structure. And finally, and probably most importantly, we have to drive a degree of predictability and profitable growth in the organization. And that is an area of focus for us. As we look at our 3-year roadmap, like I've stated previously, we've made a beginning in the previous quarter by putting together a structure and by a clear definition of strategy. And FY25, right? The current year is the turnaround year for us, where we will anchor the new org. We're making investments in our key accounts, in our service lines. We're driving an integration of our portfolio companies. I spoke about our focus on our largest clients, and we have a focus on cost optimization. FY26 is the year to continue this journey, to complete the integration of our portfolio companies. And by FY27, we expect to have reached the optimized state with an improved structural mix and a pyramid. Throughout this period, we will focus on accelerating revenue growth and improving margins. And so that brings me to the Tech M flywheel and to this wonderful graphic that hopefully you can see. So this is our vision for FY27, a top line growth that is greater than peer average, industry margins, industry standard margins, and most importantly, a high degree of predictability in our revenue and profitability that has candidly been missing in the past. How will we drive this vision? Like I shared previously, the vision has 3 elements, right? There are 3 elements to our vision. There is the growth strategy, the organization strategy, and the operation strategy that I'll be sharing about. Rohit will dive deeper into the operation strategy during his presentation. So let's start with the growth strategy, right? The growth strategy in terms of focus geos, we see an opportunity to grow faster in the Americas, where candidly we are underweight compared to our peer group. We will continue our focus on Europe, where we have a strong position and deep long-term clients and deep CXO connects. We will also focus on prioritized countries in other markets. In particular, we have a focus on ANZ, on Japan, on Singapore, and on Indonesia. I will also double click on key verticals and service lines in the next few slides. So the first from a vertical perspective is clearly telco, right? Telco has been a position of strength for us. We've got over 30 years of global experience. We have deep leadership. We have deep industry leadership in this vertical, and really an understanding of what it takes to build a world-class telco and to move it from being a telco to being a techco. We're investing in client services to grow our wallet share and to be the partner of choice for our clients. We also have uniquely got a combination of services capabilities, network capabilities, and software capabilities because of portfolio companies like Comviva. Comviva continues to expand with its Blue Marble products and the simplified telco and customer journeys. We've got a rich Digitech product suite working across tier 1 telcos across the world. And this combination of services capability, network design and management capabilities, and Comviva software capabilities, I feel are unique. This has also been recognized, for instance, by our winning the AWS Partner of the Year award from a telco perspective this year. Manufacturing and automotive have been a strength for us. It contributes more than 18% of our business. We have a strong presence across auto OEMs, tier ones, industrial process manufacturing, and aerospace and defense. Obviously, also given the heritage of the Mahindra Group, there is a deep tie-in here with common customers, common partners, and the co-innovation with M&M is at the next level now with an exchange of talent. I'll talk a little bit more about M&M synergies in the next few slides. We have deep strengths in engineering. Engineering services is a core focus area for us. It differentiates us. Our comprehensive engineering solution across product life cycles. We've got a strong IP play because of some of the acquisitions that we've done. And we've got strength because of portfolio companies like CTC, like Pininfarina, the iconic Italian design firm. Banking and financial services, again, very interesting space where I feel we really have an opportunity to capitalize on a late mover advantage. We are over $1 billion in this segment with multiple tier one clients. However, we are underweight compared to our peers, right? And this is the largest market for IT services despite near-term challenges. For us, I see significant opportunities for digital services, including cloud and infrastructure, cloud and payments infrastructure. We see an opportunity to scale up in core banking, in wealth management, in asset management, and in payments. We've got capabilities in portfolio companies like CTCo. CTCo is possibly the only digital engineering company in the world which is focused, which has deep strengths in financial services. We've got capabilities in Guidewire with Tenzing, so which really complements our insurance capabilities. And we are seeing traction in this industry with client wins and with deep client interests. From a service line perspective, we see tremendous potential in AI. We are making investments in this space. This is the year, from our perspective, of moving Gen AI to production. We're also infusing AI in all parts of our stack, whether it's application development, or it's IT operations, or it's BPS. If you look at it from an innovation perspective, we are the only company in our space to have built two foundational LLMs, one for Hindi and one for Bahasa Indonesian. Going forward, and Rohit will cover this, we will report the percentage of our clients that we've infused with AI and Gen AI offerings. We're also obviously looking to drive to use AI as a very powerful tool for internal transformation and productivity. This has taken the shape of reskilling over 50,000 employees on AI, but also on software purchases and software build-outs that we're doing for ourselves. We have launched, I spoke about the focus from a growth perspective on key accounts. We have launched a turbocharged program to accelerate growth from our top 80 accounts. We've also gotten a very clear sense now of our must-have accounts. What are the clients that we need to acquire rather than haphazardly building out our portfolio? This program will fuel further growth by strengthening the client partner role. We've got a delivery partner role. We're innovating and building for our large clients. We have a huge focus on cross-sell opportunities. We've also taken a close look at our incentive structures, right? So sales incentives are now designed to drive outcome in each of the above categories mentioned over here. We've spoken about the focus that our new structure has on addressing the complexities that we faced earlier. Our earlier structure did, to some degree, constrain our ability to win multi-tower deals because we were operating in geography-focused silos. Our new structure allows us to bring together multiple service lines to win complex engagements. And to really turbocharge this, we have formed a new group called Strategic Solutions and Transformation Unit. This is focused on multi-tower large deals. In addition to our internal transformation, we've also strengthened our advisor relationships program with a new global head and an expanded coverage for top tier and for boutique firms. I'm personally involved in this, and this has, I feel, already had an impact in higher early stage conversations in the last quarter of the previous year. We've also built out a specific private equity team and deep relationships with 3 or 4 large private equity groups to identify scale transformation programs within their portfolio. I feel that private equity, if you look at the strategy consulting firms, or if you look at some of our peers, this is a very significant portion of their revenue. And we feel that with the changes that we're driving, with the investments we're making, this will drive incremental growth, for us. We will now switch to our operations strategy, which will lead to margin improvement. I'm going to cover this only from a thumbnail perspective. Rohit will be doubling down, will be double clicking on the details during his session. So in previous discussions, I'd spoken about our 5-pronged approach for margin expansion. This includes your standard operational parameters, like our pyramid, like our offshore mix. It includes the productivity gains that we hope to drive, for ourselves and for our customers. The focus we have on moving to higher margin services, a focus on delivery excellence to stop the bleed from problem programs, and finally, driving synergy with portfolio companies, both in terms of margins and in terms of growth opportunities. We have further detailed them. Rohit will also be talking about Project Fortius. We anticipate that Project Fortius will give us average annual benefits of $250 million annually. Now, in the growth strategy, I'd spoken about high growth services like AI and engineering services. I just want to drill down on one of our higher margin services, which is digital enterprise applications. Digital enterprise applications is our package implementation business, which is a leader in established verticals in SAP, in SFDC, in Oracle, in Pega, and several other platforms as well, including IFS. We have 360-degree partnerships with key ISVs, a very strong alliance-driven pipeline, and a number of recent wins. We have the ability to drive large-scale global transformation for our clients. We have pre-packaged industry solutions, and we will look to work further on integrating the platform ecosystem, right? The shop floor to the top floor, enabled with Gen AI. So this is an example of a key service line, right? Digital enterprise applications that we're looking to drive. In addition to the revenue strategy and the margin strategy, I feel that possibly the most important focus area from our perspective, from a leadership perspective, is the organization strategy. And the organization strategy has a couple of components to it. One of the most important is the cultural transformation that we're driving at TechM. Our rich culture is what makes us unique. It has helped us to build deep relationships with our clients, but also deep relationships internally. We will retain the best elements of the existing culture, like entrepreneurship, like warmth, and build further on them. We have been working with a leading leadership and organizational development firm on culture building initiatives. They've completed a series of in-depth interviews with our leadership teams. They have spoken with our clients. They have done focus group discussions with employee groups to understand the key tenets of our culture and how we improve it. As a result of this exercise, we have focused on 4 pillars of a high-performance culture. These are simplify, clarify, innovate, and drive a greater performance orientation. We are working very closely on this initiative. This is at the heart of the new TechM. We've identified several low complexity, high impact initiatives to attain quick results. And as a team, we want to win with ideas. We want to win with execution. We want to win as a team. And I believe that this cultural transformation will help us deliver on all the promises that we're making today. From a talent management perspective, we benefit from a very strong employer brand in India, thanks also partly to the immense name recognition and respect the group has. We have the ability to attract the best and brightest in this market. We are expanding on this strength and replicating it across markets. We have recently launched an internal collaboration platform as a backbone to bring together our employees across the world and to improve our internal communication practices. One of the things that that I was told when I joined was about the need to empower leaders so they can make instant decisions to inspire their teams, and we are working on providing this freedom within a framework. We're also working on taking steps to improve diversity and inclusion. One of the most important things that you see on this slide is a huge focus on learning and development. I had spoken about it previously about Mahindra University and about the new organization that our chief learning officer is building. He spoke to our board about this today, and this really is a key priority for us. We also see a tremendous opportunity to be more synergistic with the group. And we've identified three areas, right? We've identified three sort of, not three areas, three ways in which this synergy will work. The first is very clearly that the Mahindra Group itself is driving a very deep, very deep tech transformation of their various businesses, because tech is a common, consistent golden thread running across the entire enterprise. So we will be a partner for the transformation of the Mahindra Group. So this essentially is TechM being an SI, being a service provider to the Mahindra Group. One level above this is TechM's ability to leverage group relationships to expand into the network. So it's Anand Mahindra, it's Anish, all of us working together to utilize the extremely deep and rich relationships that the group has built over the past, 75 years, the huge amount of respect the group has globally, and to leverage these group relationships to drive business, for TechM. But really, one of the most interesting areas from my perspective is the ability to use the group's multi-industry presence to work with partners, with with hyperscalers, with technology partners, with chip manufacturing companies, to create a co-innovation ecosystem, right? So how do we reimagine the future of auto, working with tech companies, working with chip companies? How do we reimagine the future of hospitality, working with Mahindra Holidays and working with other partners? This is the holy grail, and I believe that we have a clear plan to drive synergy with the group. Uh, Moving from the group synergy to the focus that we have on marketing, we really have built a world-class marketing team led by our dashing Chief Marketing Officer Piyush. We have centralized our marketing function into a single global team. This has been fostering alignment and cohesion in our marketing efforts, and will enable us to maximize our global reach and impact across brand building, demand generation, account-based marketing, and influencer relationships. It also improves the efficiency of the marketing function. And Piyush has laid out a very clear set of imperatives, a very clear set of results that will be driven almost quarterly for the next 3 years as a result of our investments in and our interventions in from a marketing perspective. Historically, TechM has had a huge focus on ESG leadership. I do believe that, I think the awards, the S&P recognition really reaffirms our position as a leader from a climate perspective. We have at the forefront of our mission is our ambitious goal of being net zero by 2035. Our roadmap for this is a multifaceted approach to integrate renewable energy initiatives, emission reduction strategies, and the adoption of circular economy practices. This also ties in very closely with what the group is doing, right? If you look at the Mahindra Group focus on renewable energy through Substan, it really is all coming together beautifully as part of our initiative. And like I said previously, our focus on ESG hasn't gotten unnoticed. You look at the award just on this page, right? The S&P Global Sustainability Yearbook 24, the only Indian company in the top 5% of global sustainable companies, our Terra Carta seal, our ESG leadership is being recognized across the world and is increasingly very important to our teams. It's very important to our clients. I will now pass it on to Rohit to talk about our plan to deliver profitable growth.
Thank you, Mohit. Yeah. So let me just talk about a few metrics or output that we are tracking towards FY27. We just talk about growth first. So if you look at growth over a period from FY25 to 27, our view is that as we get to FY27, based on the investments and the strategy that Mohit laid out, we'll be growing above peer average based on the positioning we'll be able to do from a company perspective. Although when you break it down between 25, 26, 27, our view is that next year is going to be from an industry average, a moderate year, and increasing incrementally each year as we move forward. During this period, we will also endeavor continue to invest because our case of growth is based on mostly organic basis, and we will build on our capabilities over this period of time. Strategic growth plans for each year have a specific focus on market segment and with a detailed action plan that we will execute as we move forward. When you look at margins, we have sufficient levers to improve profitability from here on, both in short term and long term. Several initiatives have already been initiated to improve margins, and more actions are planned. As Mohit mentioned on the task force, as we called it, Project Fortius, which means stronger. Focus for us is to exceed 15% EBIT margins by FY27. And when we look at the resultant of the margin expansion, you will see based on the robust cash generation and the returns that we've had over the last few years, and I'll talk about our change in capital allocation policy, we're fairly confident that based on these outcomes, the return on capital employed will go ahead of 30% and even more as we move forward towards FY27. Now, giving a little bit more detail on our Project Fortius, where we're going to work on multiple levers over the next 3 years. The actions of this has already started, right? We have a lot of scope in bringing down the average resource cost by consistently inducting freshers. The word here is consistently. We've done it in the past. We've done it in various patches, but now the plan is consistent. Over a period of time, make sure that we induct freshers, follow it up with a huge training program so that the deployment gets more seamless. So that's going to be one of the big levers that we will work on. I think we'll continue to work on wage inflation. We know it'll continue over the 3-year period. We'll work on developing a robust supply chain system and make sure the learning and development helps us enable a better internal fulfillment rate. We've taken several initiatives to already strengthen that. Mohit already mentioned the Chief Learning Officer that we've got on board, and we'll continue to build not just inducting a great program for freshers, but across the organization, building capability. If you look at our plan, which is organic, we have to continuously invest in the business. We have to make sure that we're building the capability in-house. So that's very important for us. So all of this, as we look forward from a action on productivity, be it value-based pricing, looking at sales productivity across the regions, leadership span, all of this are specific program channels within this project, which are led by specific reason and rolling it up all under our Chief Operating Officer's domain. And I'm working closely with him to drive outcome based on these specific plans. Now, in order to achieve growth or above peer average as we move forward, right, and able to drive these savings, we have to invest in the business, right? We have to make sure that we look at this from a long-term perspective and not just short-term. So for that, we've done a detailed assessment on what we need. We've gone an extensive evaluation of 16 market segments, each one based on market growth prospects, TechM's ability to win, right? We've evaluated more than 100 benchmarks to identify the areas where we need to invest so that we are able to prioritize a set of investments, plug the gaps that we have, and improve our positioning in these markets. These areas can broadly be categorized into service line offerings, into sales and marketing investments, into the whole ecosystem, the ecosystem of hyperscalers, niche, domain-specific players, industry analysts. We need to continue to work with them and invest in this area. So we'll make sure that we're setting this business more for long term, and to be able to do that, we continue to work on all of these pillars to structurally invest and develop, both for growth as well as enabling margin expansion, right? Example, if you have to expand margin over a long-term period, we have to invest in internal tools, we have to invest in people's supply chain capabilities, we have to invest in various platforms that help us unlock value over a long-term period. So that's why this is going to be the most important aspect for us, because in the short term, we'll have to do above normal investments that help us unlock that value, both on margin and growth perspective. As we move forward to FY26, probably that will reduce to half and then get embedded in the normalized run rate of margins, right? So in the initial year, in fact, in FY25, this could be in the quantum of 1.5% of our margins, going down to half of that, as I mentioned, and then getting embedded in the margin rate. So this is the roadmap from a margin perspective. As I mentioned, we're at 6% this year on EBIT rate. Cost savings under Project 40 is going to be the big driver for us to be able to get the savings. As Mohit mentioned, we'll continue to work on the portfolio mix, geo-wise, service line-wise, vertical, which will give us better long-term returns in terms of expanding margins. And then wage hikes will happen over a period of time, which, as I mentioned, we will offset with some internal fulfillment and other levers. And then the investment, right? As we do the investment, more in short term, less than that in medium term, and that gets embedded to give us returns over the long term period. And with that, we see a roadmap to getting in excess of 15% EBIT over FY27. So this is another thing I mentioned earlier. I wanted to highlight our current, where there's a change in our current capital allocation policy that we got an approval from the board. In the go forward policy, we have an endeavor to distribute at least 85% of our free cash flow generated over a period of 5 years to shareholders in the form of dividends or buyback. So that's a change we wanted to drive to make sure that we're generating a great shareholder value, all in terms of getting a top above average growth, expanding our margins over a period of next 3 years, and then returning back significant amount in the nature of dividends of buyback. And we also wanted to share some metrics on what are the input metrics that will help us get to those outcomes, what helps us get on growth that we're looking at, what helps us get on the margin rate, and then the organization talent, how are we growing on that. So these are some of the ones that we'll be internally tracking, and we'll share a constant update on how we're progressing on this. Some of this we already externally shared, and we'll add the others as we move forward. So example on growth, how do we grow our top accounts, the turbocharge program that Mohit laid out, the focus on the top markets, right? Increasing our book business. And then on margins, looking at how do we work on correcting our pyramid over a period of time. This is a long-term benefit, but we have to invest now. So this is an important metric for us to track. And then the high value service line, we'll invest on that capability build, as I mentioned, organically. And that will help us grow the revenue on those service lines, which are better yield and better margin oriented. And that will help us drive better EBIT over a period of time. And similarly on organization and talent, we'll continue to upskill our people, invest in L&D, as I mentioned. Mohit mentioned we'll share the percentage of clients where we're infusing Gen AI offering. That's a very important lever that we're tracking internally. And then overall, the DI focus continues, and we'll continue to share these metrics as well on how we progress. I'll hand it back over to Mohit to wrap it up with a recap on our scale and scale narrative. Mohit.
Thank you, Rohit. So look, I think that is our strategy across the three pillars of growth, of operations, and the organization. And obviously, we will keep you posted on this as we move ahead. I do feel that we have an incredible platform, right? TechM has an incredible platform. There's the ability to do so much more. I believe that we have the leadership team in place now that will allow us to make this significant jump to meet the promise that we have laid out for you from an FY27 perspective. But I also want to mention that beyond what we have committed for FY27, right? Because I do recognize that there is much more to do beyond FY27 as well. And what I want to say is that in the longer term, beyond FY27, we want to ensure that TechM is the market leader from a growth perspective, not just above average. We want to make sure that we are in the top 3 of our peer group from an EBIT profitability perspective, not just the number that we have shared with you. So our longer term ambitions and our longer term aspirations are more aggressive than what we have shared from an FY27 perspective. But we have to make a start. We have to make a start. And so therefore, this is what we feel the roadmap and the trajectory will be, for the next 3 years. As we were preparing this presentation, as we were speaking with our leadership teams, the thought that struck me is over the past year, there has been this narrative, this incredible energy around the India dream, right? Around what can be accomplished, what is being accomplished in India today, the fact that we have hopes and aspirations for what this country will be over the next many years. And I feel that same ambition, the same aspiration for TechM. Like for India, I believe that the moment for TechM has truly arrived and that we will be moving onwards and upwards from here. Thank you so much for your time.